Welcome to another Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, not having a clear plan, is the enemy when it comes to exiting highly appreciated assets, so that you can defer capital gains taxes. You want to make sure you have that. And so each and every episode, we're bringing on some of the best real estate, financial wealth, and business minds in the world, where they share their ideas, deal stories, and inspirations. So together, being a complex tax deferral strategy simple and passive income plans achievable. We're also streaming on expert CRE secrets as well for all of the commercial real estate people out there. We so appreciate you watching or attending on YouTube. Excited about our next guest. He's a trailblazer in the financial industry. He's having kickstarted his career at age 19, and he quickly rose to a position of manager. And by 26, he became a senior manager. An impressive feat considering average senior manager was in his early 50s. He's a talented for growth and expansion, and his team opened multiple financial services in Arizona, Michigan, Southern California, setting new benchmarks for success in the industry and so much more. We're going to be talking with Jon today, all about premium financing and ways to build wealth. If you are looking for insurance and ways to do that, please welcome to the show with me, Jon Loyhayem. Jon, how are you doing?
Another day in paradise. How about yourself, Brett?
Fantastic. And for our listeners getting to know you for the first time, can you give us a little bit more about your story and your current focus?
Okay, yeah. As you said, I started in the industry when I was 19, specializing in life insurance and annuities and so on and so forth. In the previous company I was in, the average age of a life insurance or financial planning expert is usually 50 years old. So me starting at that age and then being able to succeed and move up in the company I was in was very rare. At the same time, I eventually trained a team and managed other agents, and we opened up multiple branches until we spun off and opened up Alivo during 2020, during the COVID pandemic. It just turned out it was the best time for us to do that. Our current focus is our company focuses on working with high net worth individuals to help them with their life insurance needs and their planning and the planning needs that they need, whether that's leaving a legacy for the next generation or helping or deferring taxes or mitigating taxes using different strategies using life insurance. My main focus is obviously expanding the company and working with more agents to help them offer these solutions to other clients and other high net worth individuals.
Fantastic. Let's dive right to the topic at hand, which is premium financing. So, Jon, I know we're also going to touch on the context of, kind of what went wrong with some of these premium financing plans here in a minute. But let's just start out with what is premium financing and what's the best, kept secret when it comes to premium financing?
Okay, so premium financing is when you finance a life insurance policy. Instead of paying with your own money, you pay for the life insurance policy using the bank's money. Now, why is that great? Why is that awesome? Well, look at it this way. What do we actually pay cash for nowadays? Right? In most cases, we're paying, you buy a house. When was the last time you heard of anyone buying a house all cash? Unless they're about to refi it 20 minutes later, or a couple of days later. Commercial properties. I don't think I've heard of anyone buying a commercial property in cash in the last 15 years. Right? Cars, right? We finance our cars, we finance our motorcycles, our yachts, and so on and so forth. So premium financing is buying, let's say, it was developed originally for buying a $25 or $50 million death benefit or a life insurance policy using as little money as possible, right? With just using the bank's money. Now, in the simplest concept, what would happen is you would borrow money from the bank, you would buy this life insurance policy. When you pass away, the bank would get the money that they loaned you plus interest, and it would come out of the death benefit, right? So let's say you bought a $50 million policy, the interest on the premium and the interest in that case, when you passed away was 12 million. The bank would take their 12 million. They're happy because they got their interest. Your family would receive 38 million, right? Or
Perfect. Got it. Yeah. So you're able to finance what you would have bought anyways, but instead of buying with cash, you use the bank's money to finance it and get a bigger payout. And the bank gets paid when you die with the interest and whatever the amount that was, and your family gets the other benefit. Is that a fair summary?
Yes. Right.
Excellent.
And one benefit of life insurance is that it's income tax free. So the death benefit is 100% income tax free. Estate tax. Most of the time, people who need these type of policies do this for estate tax purposes. So I think you can correct me if I'm wrong, but the estate tax exclusion is around 13 million
Per person per year right now. Yeah. And then it's set to probably cut to about 5 million that we've heard in 2026 per person. So a married couple will be about 10 million in 2026, single about 5, but we'll see where those numbers actually shake out. But right now it's at the highest it's been in a long time, which is about 13 per person.
And I do think that they're going to go down. We're always saying that taxes are going to go, with the current US debt, what's going on, taxes are going to go up. What most people don't realize actually is taxes have been increasing. They just might not be income tax. During the CARES Act, one thing that changed, and this is completely unrelated, but a lot of people don't realize is a lot of people who had money in IRAs, if you passed away before you took all the money out, that IRA or 401k is now an inherited IRA. Pre the CARES Act, that IRA would just transfer. If I inherited an IRA from my dad, that IRA would just transfer over into my IRA. I could just do a direct rollover. I could just move the money into my own retirement plan. Nowadays, what's happened is you have 10 years to take that money out and pay all the income taxes that weren't paid on that money that's in that IRA and in that 401k. It was something slipped in to increase taxes. And what most people don't realize is taxes are going up, but it's the taxes that don't affect most people. Like what percent of the population does that affect at a certain time? Maybe 0.5% of people who are inheriting IRAs from their parents, or 0.5% of people are affected by that, right? Now think about what percentage of people will this estate tax exclusion actually affect, right? How many people are actually going to inherit more than 5 or 13 million? Now, if you're in California, you buy a shack of a house, it's 1.2. I'm in the market looking for something and constantly disappointed, but yeah. So
yeah, that's a great point. I mean, that's actually a good thing to think about, right? Looking at tax flow, not just cash flow, and understanding that if you're getting an IRA from your mom or your dad and it's 10 million bucks, let's just say, right? Guess what? You need to take $1 million basically a year over that 10 years. I don't know if it's divided equally, right? But you're going to pay taxes on that million. It's going to be ordinary income tax, which is the highest tax rate. Am I hearing that right, John, on that IRA piece?
Yes, it is.
That's brutal. Whereas before, it would have just rolled into your IRA and would have pushed out until you were a certain age, right? And then you take the minimum required distributions, right?
Yeah, exactly. Which is what happened when my dad passed away. I was 19, when I was 17 when he passed away, which is why I'm so passionate about this industry. He had like a $10,000 IRA. I just rolled it over and used it to pay for college, right? But I didn't, and I paid the penalties on it. But I could have rolled it over into my regular IRA versus most people would have. Now you have to take that money out little by little. So there's that. You're exactly right. And on a higher amount, it causes a lot of issues.
Absolutely.
So
let's dive right back.
You're looking at 40. If you take out $1 million a year out of a $10 million IRA, you're looking at $450,000 in income tax.
It's substantial. Yeah. Now let's dive right back into premium financing, right? So use the bank's money. You can borrow to fund this insurance policy. And this insurance policy could be used to offset taxes because it's income tax free, right? Anything else to add to the premium financing? And then let's talk about the state of it right now with interest rates going where they have gone, and people maybe have, who are in adjustable, premium finance policies that have now adjusted to the high and now they're upside down.
So anything else to add on it? Yeah, premium financing is like everything else. It needs to be designed correctly. It needs to be structured correctly, right? I just gave you the most basic concept, and I'm sure a lot of your listeners are going to be like, oh, I want to do that. There are other rules depending on how it's designed. Sometimes outside collateral needs to be brought into the situation just because the collateral in the policy, because the policy serves as a collateral. right? So if the of the premium financing. So if there's an investment portion of the policy and the policy isn't performing, there needs to be some type of outside collateral, whether that's a brokerage fund or a real estate piece or something to serve as that. As far as that goes, and it could be used in a bunch of different ways. We've seen a lot of people, and this is going to tie into the next case. A lot of people have done premium financing to supplement their retirement needs, because again, a lot of life insurance policies have a cash value portion that grows depending on the market, whether that's a mutual fund or a S&P or a stock-based index like the S&P 500. What'll happen is that account will upgrow average 5 to 8 to 10% a year, depending on the company, depending on the growth strategy. And their original plan was to make money off of the money. You're borrowing money at 3% for a long time. The S&P 500's average 6 to 7%. And inside of a life insurance policy, the growth is tax-free and the distribution is tax-free if you structure it correctly. So you're making 3 or 4% on arbitrage on that money that you just took out. Now, using that and then there's a bunch of other things that inside the life insurance policy that make it ideal for retirement planning. However, most of these policies, most of the time, you're relying on that arbitrage to be there. And I froze. I forgot my train of thought.
You're fine. You're good. Yeah, you're good. You're still going. I think sometimes the restream will freeze it, but you just keep talking and it'll kick back in. But you're actually still streaming. So keep going, Jon.
Right.
So yeah.
So what happens is a lot of people have used this to supplement their retirement planning, not for the death benefit. The death benefit was an added plus. The biggest issue that we've seen, and this is where a lot of we were talking about the rates going up and so on and so forth. When someone does premium financing in a traditional sense, meaning they go ahead and they use it for a death benefit need to leave money over to their family, right? For estate preservation or wealth creation or so on and so forth. Those are usually fine because they're paying, most of the time, those guys are paying the interest out of pocket every year. So let's say on a $100,000 premium a year, the interest is $8,000, but you're paying $8,000 a year, you're getting a huge death benefit. Triple of what, if you take that $8,000 a year, you might have gotten an $800,000 death benefit. But with with premium financing, you're getting a $30 million death benefit, or exaggerating a little bit, but you're getting a $8 million death benefit, for example, right? Obviously, age and other factors apply. So premium financing was ideal in that case, and you're just paying that $8,000 a month out of pocket. However, when people use this to structure as a retirement plan, what most people didn't realize, and what I can say a lot of people who are trained in premium financing may or may not have mentioned, is that their expense charges in the policy, and there's a cost of insurance. The policy has to perform with a 2% or 3% arbitrage every year, meaning it needs to outperform whatever the loan rate is by 3% for the policy to work on a retirement level, for actually not even the policy to work, just for the policy to stay level, right? So the policy doesn't need additional funds or additional collateral. Now, for it to also perform on a retirement level where you're able to take distributions from the policy, you're not going to be able to take distributions for retirement, a supplemental retirement income, unless the bank is paid back. Because remember, the policy is a collateral, right? Just like, if we had a piece of property, we sold our house, right? The bank's like, hey, you're paying off the loan first, then you're giving me then you could take whatever the profits are. It's the same exact thing. The policy serves as a collateral. So anyone who put money into the policy, if it wasn't performing well, they're negative. Now, in the last 2-3 years, we've seen interest rates. We've gone to a high interest rate environment. The Fed's increasing it. I think at the time of recording it, they're saying they might increase it another 0.75, if I remember correctly, or another quarter point. A little bit behind on the numbers of where the interest rates are going, but regardless, the interest rates are a lot higher. The market's been forming, but it's been volatile, and depending on when your statement is and when your loan is due, you might be upside down. right? So what we're seeing in a lot of cases is, say someone got a 2% return on their cash value in their life insurance policy, but their loan rate went from 3% to 8%. So now they're -6, right? So, and unfortunately, majority of the premium financing cases that I've seen in the last 3-4 years, that we've seen other people do, are these plans are structured for more retirement, a supplemental retirement income. So they need the positive arbitrage to hedge out, right? Now, if they're in one of those cases, are there things that they can do? Yeah, there's a little bit of restructuring. There's deferring the tax. There's having the plan run a little bit longer, maybe an extra 5 years, and so on and so forth. But using premium financing outside of what it was traditionally for, it doesn't work in a high interest environment unless you're putting a lot more money into it than what you would have in a low interest rate environment.
Got it. And this is why you got to get with Jon at alevofn.com. It's alevofn.com. Jon is spelled with no H, just JON at alevofn.com. Because guess what? If you are looking at premium financing, you got to make sure you have an expert like Jon to walk you through all of it, the structuring, the pros and cons, the risk challenges, and the way to do this where you're not going to be upside down because maybe it was an adjustable rate. Jon, can you get fixed rate financing on premium, or is it typically always adjustable?
It's typically always, I'd say 80% of the time it's adjustable, but now we're going back to the fixed rate. And they don't really call it adjustable. They call it variable, meaning it's from year one, it's fixed for a year. Then after that, every year it changes, depending. Like it can go up, but it'll also go down, depending on the interest rate environment. A lot of times people are getting fixed rate. I have seen people get fixed rate ones. They were rare until this last year when the interest rates, and the last couple of years when the interest rates skyrocketed. But yeah, fixed rates are also available. But again, it always depends on what the numbers are, what type of policy that what they're looking at, and how that policy is going to grow over time.
So who is it not for right now? I guess, let's say if I'm worth $10 million and, I just sold a highly appreciated asset and I've deferred some of the tax with the deferred sales trust, let's say, or I moved the funds outside my taxable estate. I sold $100 million asset in Santa Monica, right? It's this big business I had for 30 years. And I sold the business and it's already outside of my taxable estate. So I don't need anything to offset estate taxes, right? I'm trying to figure out, especially for our audience, right? We use the DST as a way to defer cap gains taxes, but also looking for ways to invest. So I guess give it from the investor perspective and not so much the estate tax, offset.
So, well, in this case, did they already pay their taxes are deferred?
Yep.
Right. So if taxes by deferral, when will my question would be, when would their taxes be paid? Right.
So on the DST 1.0, it wouldn't be paid. They can pass it to kids. There's none of the IRA, 10 years thing that we talked about before. There's no required minimum distributions. Although we do take some payments out starting in about year 2 on the cash flow, right? But the principal can stay intact. On the DST 2.0, it's eliminated outside the taxable estate, and the children, are the beneficiaries of that. But it's already outside the taxable estate, so they're eliminating that 40% death tax there upon the death of the mom and the dad. So we like to say the DST Plus is the way to solve the estate tax without any life insurance, charity, or gifting required. That's part of why we like it so much. It's just such a one size, huge fit. Does take a sale, does take before someone dies, you have to do it, all set it up beforehand, but there's no life insurance required.
That's amazing now, but there's still going to be a capital gains tax portion that's eventually going to have to get paid.
Yeah, so the cap gains tax will be during their lifetime. So it is actually formed as like an annuity payment on the DST 2.0. And so it's part interest, part principal based upon life expectancy. And as they receive payments, Jon, they'll pay some cap gains tax and some interest, which is ordinary income tax, over their lifetime. It's a fixed payment. Then when they die, their children receive it capital gains tax free, but in the sense the parents have already been paying it over their lifetime or a lot of it. But whatever's remainder is it's outside the taxable estate and it's capital gains tax free. On the DST 1.0, the capital gains tax is always in there, and the children step into the shoes. And then once they step into the shoes, if they dip into principal, they will pay capital gains tax. And so that one doesn't ever go away. That one will be deferred until the kids dip into principal.
Okay. So the solution would be is just what you said. They're still making the payments, but how could they supplement the payment? How could they make up all the money that they paid in taxes, right? By adding a life insurance, whether it's financed or not. A life insurance, you're avoiding paying the estate taxes, right? But you're not avoiding a lot of the money is being left over into capital gains. So just life insurance in general is you're paying pennies on the dollar. You get a $1 million death benefit and you might be paying, I don't know, 1,000. If you look at your total premiums until you're 85 or 90, which is a life expectancy of most average Americans, if they're healthy, assuming, right? Their premium is usually half of whatever the death benefit is, right? So there are those different factors that once you combine both these strategies, you could leave a lot bigger of an estate for your beneficiaries.
I like that. So it's like an investment, right? So you say, look, you have this extra cash flow, and if you're this high net worth, we're going to use it as a bigger impact for your beneficiaries, right? And so it's like, let's say it's a $10 million death benefit, where you're saying the premium is half is on average. Is that what you said?
It depends on the type of policy. It depends on the plan, and it depends on obviously the person's health, whether a smoker or non-smoker. Some companies ask if they work out every day, right? I've seen, and it obviously depends on how old they are when they get the policy and how the policies were structured. But I've seen premiums the total premiums until 85 or 90 be 30 to 50% max. Okay. That's if they're, slightly unhealthy, meaning below a standard rating. But most of the time, the premiums will most of the time they're only paying 30 to 50% of whatever would be left over to the family.
Okay, so for example, if I'm 60, I'm in good health, I want to do a $10 million policy. Let's just say 30%. It's about 3 million. I'd be paying that over like a 20-year period of time, or a 10-year. You said to 85, so 15-year period of time. So it'd be 3 million divided by 15. Is that a good way to look at this? So it'd be about 200,000 a year, or about 16,000 a month.
Yes, or you could do it, or it would be a lot less if you dump the 3 million in ahead of time. You might even get away with putting in 2 million.
There it is. Okay, yeah. So you could pay it up front, right? And I guess kind of like finance yourself, right? So different ways to do it. Okay, it's making some sense, right? And so it's like a hedge. It's like, hey, I know. It's almost like, hey, I know if I put 3 million towards this premium financing, or even just this life insurance policy, whether you use financing or just fund it, I know my return is definitely 3 million plus 7 million, right? When I die. Is that and that's essentially what it is, right? I mean, life insurance policies pay. So it's almost like there's no risk, right? You're just like, it's going to pay. It's going to pay my family. I'm just going to finance it. It's going to go. Is that a good way to think about it?
Yep, 100%. Actually, there's actually a case study. There's a family, I can't say who it is, but they're in the Midwest. And I think 3 generations ago, or 2 generations ago, that was exactly what you said. There was a wealthy individual. He built a business up. He sold it, and what he did is he took most of the sale and he bought a huge $300 million, or back then it was $200 million death benefit. Put it in a generational trust. The next generation was told, when I pass away, you get this money. You have to go and take 1/3 of it and buy another life insurance for your next generation. So I believe they're on generation number 3 or 4 of all the family does is just get a huge death benefit, 30, 40 million or 200 million, depending, or I think the last one I remember reading was 130 million. They went back, took 40 million, put it into another life insurance policy. And that way the next generation is guaranteed to receive 150 million, right? But we see those things all the time. Obviously, they're a little bit rarer when people want to create multi-generational wealth, but it's because a lot of people, I'm sure they might want to
Yeah,
invest.
I mean that whoever that grandfather was, right? He did something right.
He did
He did a
something
lot
right,
right,
and
right? He just
everyone knows who
all of
he
it out. We're
and
gonna take it all of it out, John. Right? We're just gonna say, look, no, it's not gonna be any. It's gonna be in the generational trust. It's gonna be, I guess, mandated, right? That if you're gonna get this money, a third of it must go back in. Is that what happened, John?
yes.
That's really cool. Awesome, John. I think we covered quite a bit. Anything you else want to touch on before we go to the lightning round?
No.
All right. So let's go. Knowing what you know now, if you go back to your 25-year-old self, what's the one golden nugget make sure to tell yourself to do?
Believe in myself more and take a lot bigger risks a lot faster.
Excellent. And what's the one golden nugget, or what's the one number one book you recommend or gifted the most in the past year?
The past year, I'm reading right now. There's two, I would say. I'm reading Alex Hormozy's $100 Million Leads. It's an amazing book. Another one I just read in the past year, it just came out in the last year, is Unreasonable Hospitality. That was really good as far as just going the extra mile for customers, clients, showing that extra level of care. And the third one, which is a very old one, but if you're a younger business owner and you're looking to build up, it's called Barbarians to Bureaucrats, by Lawrence something. It was written in the 80s, and it talks about the corporate life cycles, not styles, life cycles of most corporations and what causes them to collapse.
Awesome. Amazing. Hey, last question. And is this, John, after all your success helping all the people you've helped, what would you say is the one thing that you practice to stay centered in your values and stay encouraged to charge forward to reach higher heights?
So what is that another way of saying what keeps me motivated? Just being around people who are more, who are more successful than I am. And that's really it. Just being in the room with, obviously I'm a little bit younger, and being around people my age, I'm usually doing better than most of them. But when I go into a room with other people who are more successful, it puts everything, it's a perspective thing, right? I always like to be a small fish in a big fish tank versus a big fish in a small fish tank, because there's no, you're the ceiling then, right? The law of lid always comes into effect. So I always like to look for a room where there are people who are way more successful than me.
Amazing, John. It's fantastic. I love that wisdom, and I love you sharing your story. I love your heart for helping people and keeping it straight to the point, right? What needs to get, what would need to get done, what it is. You're transparent, you're straightforward. I love it, John. For our listeners who want to get in touch with you, could you remind them one last time, what's the best place for them to find you?
Best way to contact me right now is Jon, Jon, at Alevofn, ALEVOFN.com. We're in the middle of redoing our social media. I'm on Instagram under Jon.Loyhayem, but I don't check it as much right now. We're again redoing our social media and our marketing.
Amazing. Loyhayem is spelled Loyhayem. And well, thanks, John, for being on the show. I also want to thank our listeners for listening to the episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax referral options. Not having a clear plan is the enemy, and using a proven tax referral strategy such as the deferred sales trust is an amazing way for you to create and preserve more wealth when exiting highly appreciated assets of any kind: crypto, business, real estate, and getting with someone like Jon Loyhayem to maybe do some premium financing, maybe do some life insurance planning, right? So you can have a plan and have opportunity to give generational wealth. Amazing, great stuff here today. I appreciate everyone out there. We're also streaming expert CRE seekers as well. So appreciate everyone out there who are listening and watching on YouTube. Please rate, review, subscribe. And don't forget the book that we released, Building a Capital Gains Tax Exit Plan. It is the proven playbook for unlocking your assets of any kind when exiting, deferring capital gains taxes, using the deferred sales trust. So check that out. And that being said, we will talk to everyone again real soon. Make it a great day, everybody. Bye now.